So hey, it's Ken, and I have an amazing guest with me today. Laura Witt from Mortgage Architects is with us here. You can see her on the screen. I'm not going to do a long introduction. I'm going to let Laura sort of tell us about herself and all the things that she's doing. So Laura, how you doing?
Good, thanks. How are you?
I'm doing well, thank you. I'm doing well. Tell us a bit about yourself, Mortgage Architects, and sort of what you have going on.
Yeah, awesome. I've been arranging loans and in financing for 10 years now, 6 years specifically in the mortgage industry, and this is my fourth year independently as a mortgage agent.
Okay.
And I just joined Mortgage Architects actually last year in June. Made the switch from another brand, and it's just really allowed me to reach more clients and do more for them by having access to all lenders across the board.
Awesome. Awesome.
Yeah.
So let's dive right into this. So today's episode is specifically going to be on the topic of mortgages, interest rates, sort of what's happening in the real estate market. So I've got a few questions, and I think a lot of people are going to watch this are going to have the same questions. So uh, with what's been happening in our kind of our main economy and globally, where do you think the Bank of Canada is going to go with interest rates this year? Are they going to stay where they are? Going to go up? They're going to go down? What are your thoughts?
Yeah, I don't think that they're really going to be going anywhere. That mood's kind of changed since the end of last year. Last year, the idea was that we're probably going to see about 3 interest rate increases throughout the year, and just kind of the health of the overall global economy has changed, and I don't see rates going anywhere. On the flip side, so that would be affecting variable rates. On the flip side, I have seen fixed rates come down. I've been reporting changes. I do a mortgage rate Monday, and I've been reporting decreases on the fixed side
Okay.
since March 4th. So that variance between the fixed and variable has really come down. It's typically a wider gap, and variable has been very attractive, but it's about a 0.09 difference only now. So a lot of my clients are going fixed versus variable.
Okay, so let's dive into that, and just to kind of go over what you said there. Are you expecting? And obviously, this is speculation. Nobody has really any clue. The banks and government can do whatever they want at any given time. But are you expecting the Bank of Canada to hold the rate for the rest of the year?
Yes,
Okay.
I do.
And then how is that going to affect like the typical bank, their mortgage rates? What do you like? Are they going to stay the same, or do you think they're going to go up or down?
Um, Seasonally speaking, this is the time of year, like the spring and summer is where you start seeing rates advertised, rate specials going on, because this is when the banks and everyone fills their pipeline, right? So they want to have
Right.
a leader out there so that they're bringing in business. So I think on the fixed side, we'll continue to see kind of those rate specials being advertised, which is great for everyone. The variable side, I don't see a lot of changes. And I mean, there's still priced around prime -1, prime -1.05. So that's still under 3%. But I don't see too many changes happening. The variable rates have been kind of holding steady where they are.
Okay, cool. So let's dive into fixed versus variable. I have this conversation with a lot of clients in respect to when they're thinking about getting a mortgage. And I'm obviously not a mortgage expert. I try to do as much research as possible and talk to experts like you. But in terms of going fixed versus variable, and I think it probably has a little bit to do with amortization as well. We can talk about that. But what are you recommending people right now in terms of the overall view, let's say for the next 5 years? What's your professional opinion, fixed versus variable?
So that's interesting. It also depends on kind of what clients are doing. For example, I have a lot of clients that are, I guess, in their mid 20s to mid 30s that are just getting into the market. Maybe they're in a condo unit and they have bigger dreams of getting into a semi-detached or fully detached home. Having said that, a lot it can change at this point in 5 years. So 5-year fixed, I steer a lot of my clients away from, because statistically speaking, they're broken in month 38. So just over that 3-year mark. Now, if you're in a fixed rate, you're going to incur a huge penalty, unfortunately. If you're in a variable rate, it's only 3 months interest. So kind of looking not at just where rates are right now and what the best rate is taking a look at like the next 5, 10, 15 years and what a client, assumes their next steps maybe.
Right.
I'm always a big believer in variable, but because of that small variance, I've been talking to more and more people that just feel more comfortable with the fixed rate. In the past, we'll see the Bank of Canada increase the overnight lending rate by 25 basis points or 0.25. And at that point, if they increase the rate once in the next 5 years, it's going to be higher than the fixed rate. So straight fixed versus variable, more people are choosing fixed. But if you'd like that flexibility of getting out with being penalized, shorter term fixed, or look at that variable. It'll save you money in the long run.
Now, I know you have a background in economics. When we're talking, we've got a lot of things coming up in the U.S. economy and the Canadian economy with respect to elections. We have, and this is not to get political, we're not going to do that, but this is, we have our election up here coming very quickly, and we also have the election coming up next year very quickly. What are your thoughts on are mortgage rates, or is the real estate industry from the mortgage side, is it going to be affected much by these elections? Do you think that it's going to have a factor? And is that what potentially people are getting a little bit concerned about with potentially going to fixed? Or is it more just a lot of people are unsure, so they want a sure bet and keep it in that fixed kind of, the fixed rate?
Yeah, so that's a loaded question. I mean, as far as interest rates are concerned, definitely kind of how this country continues to rank on a global scale and also just be run independently will have a huge bearing on interest rates. There's no question with that. And definitely, the party that's going to be coming into play can also affect those rates, but also rules. I mean, over the last 10 years, we've been seeing nearly a new rule released every year, the latest being B20, which created a stress test for people that have more than 20% down. And that really changed the dynamic of the industry and even the real estate market, right?
Right.
So yeah, absolutely. All those things will definitely come into play, and hopefully it will improve versus kind of dampen prices and the economy as a whole.
Can we touch on that B20 rule change real quick? I know a lot of people have heard about it and they don't necessarily know exactly what it is or even the dynamics of what has changed. They walk into their bank, talk to a mortgage professional, and are told that you could have gotten this, but because of these new rules, now you can only qualify for that. What is B20 and how has it affected our mortgage and real estate industry?
Yeah, great question. So if you have less than 20% down, the rules haven't changed. There's always been that stress test for buyers, and that's come down from the federal government and CMHC rules, which is the insurer for default and high ratio mortgages. Now there's a stress test rather for those who have more than 20% down. So the old rules were, let's say that your 5-year fixed rate was at 3.14%. Your affordability ratios and the amount of a mortgage that you can qualify for was based on 3.14 and making mortgage payments on that. B20 came in and said, no, we're going to be overextended. That's not a great rule of thumb to go by. So the rule now states that you must qualify at 2% plus your contract rate, so 5.14,
right,
or the Bank of Canada 5-year benchmark, which is 5.34. So having said that, that really brought affordability down roughly by about 12%. And as a result, you've been seeing a lot of pricing kind of in that detached and semi-detached market come down. And people are priced back into condos. So condo prices have continued to be where they are, which has been good for the condo market, I guess.
Right. So as an overall percentage, if we use real rough numbers, my understanding is it's basically taking like 8 to 12% off of what you could have normally have afforded. And now, so if we use $100,000 just for simple numbers, so people understand very quickly without pulling out calculators, someone could have used to be able to get financing for $100,000, and now it's down to 90 or even like $85,000. Real rough, real but typical.
Yeah, yeah, absolutely. So affordability wise, I believe it's roughly $26,000 less that you would be approved for on the mortgage side.
Right.
So that does, yeah, absolutely play into affordability and what people can afford and buying power. And that 30,000 difference could be the difference between a townhouse and a condo for a lot of people, which is why the market and prices have reacted the way they have.
Right. So does this also affect refinancing?
That's a good question. Refinancing, yes. Because if you're refinancing, you're essentially redoing your mortgage. So you are at the mercy of whatever current mortgage rules are.
Right.
From a renewal standpoint, so that's at the end of your 5-year term, you get a letter in the mail that says, hey, Ken, thanks so much for paying your mortgage. Would you like to lock into a 1 year at this, 2 year, and initial and send back? No, it hasn't, because you're not requalifying for a mortgage at that point in time. Yeah.
Got it.
But if you're to switch, if you're going to switch from that lender, like let's say your bank's not offering the best rates and you want to go to a different bank, you would have to requalify at that bank, and it would be at the new B20 rules. So you could be in a compromised position depending on your situation.
And just so people understand, if they don't know the difference between a renewal and a refinance, you did explain it, but if you have a $200,000 mortgage left on your house and your term is over 5 years, like you said, you're checking off 1, 2, 5 year, whatever the criteria is, you're just going to continue making your mortgage payments and not refinance, meaning pull any equity or any money out. Or if you're not switching lenders, that's just a renewal. If you're pulling out, let's say $50,000 to do home renovations or maybe pay credit cards off or whatever that is, that's a refinance, and you would be subject to the new B20 rule.
Yeah, correct. Exactly.
Okay.
If you're making any material changes to your mortgage, so if you're changing your amortization, maybe you want to increase it to help with cash flow and have lower payments, that's considered a refinance. And if you're changing the loan amount, so if you're not just renewing and you're adding debt to it, again, as you said, exactly, that would be a refinance. Yeah.
You touched on amortization there. Let's talk about that real quick. So what are most of your, and for people watching, there's so many different, and there's going to be a lot of different people watching this, whether you're a first-time home buyer, maybe you've owned a house and it's time you're starting a family, you want to, get into a larger house. Maybe you've had a house for a really long time, your mortgage is paid off, you're going to buy a condo and you still want to put on a little bit of a mortgage or a home equity line of credit. Investors, there's a lot of people that are going to watch this. So the answer can be different. I'm pre-qualifying the list by saying this. Talk about amortization. What are most people doing these days? I know the Bank of Canada a while ago made it, I think we used to be able to get 35-year term.
Even 40.
Even 40. And so that's now down to 30, right, is the max?
Yes, so long as you have more than 20% down. The maximum amortization for a high ratio is 25 years.
Okay, so that's good to know. So if you have 15 or less percent, so like it's 20 or less percent down, you can only go 25 year.
That's right.
Okay, so that's really interesting. So are you seeing a lot of people put down less than 20% with people that you're dealing with?
No, and that's kind of been the strange shift since, I guess, these B20 rules have come into play as far as the makeup of what my book of business has been. I've seen less and less high ratio clients. I don't know if people have just been saving longer or getting gifted money from mom and dad. That helps as well. I'd say traditionally speaking, for first-time home buyers, they're doing the minimum 5% down. There is a sliding scale, so that's a blanket for the first 500,000, and then it's 10% on the next 500,000. But first-time home buyers, it's tough to save and it's tough to get ahead of the game. So amortization for first-time home buyers being high ratio is being maxed out at 25 years. For refinance, still, or clients that have more than 20% down, I mean, they got there for a reason, and they're not looking to help with cash flow and take 30 years to pay off. A lot of people are still only choosing a 25-year amortization.
Right.
Yeah, I guess to each their own. But I would say the majority still just stick to a 25-year amortization. Now, there's other, what would we call them? Techniques, I guess, or tools that you can use with your mortgage in order to pay down your mortgage faster. And that's by doing accelerated payments
Right.
or lump sum payments. And that can shave off years and tens of thousands of dollars by exercising either of those. So I was just helping somebody with a 30-year amortization. She's got a great down payment. And I said, listen, I know you're paid monthly, but if you want to do an accelerated weekly, you're going to shave off 3.5 years from your amortization. And what was it? $30,000 in interest.
Wow.
And if
Wow.
they weren't comfortable with an accelerated payment because it is a little bit higher, then if you put $5,000 down every single year, she was saving about $30,000 still in interest. And I think it was maybe 2.5 years off. So it's not as much off the amortization, but big tools that make a big difference.
For sure, especially with that interest, it really, I don't think a lot of people, and I'm of a couple of mindsets in the sense of, as long as our real estate market keeps appreciating, which it's a challenge, right? Who knows in the next 5 years where we could be as an economy again in Canada and then North America and then globally. There's a lot of signs of things maybe turning south a little bit, and we've been going strong for a super long time. So there's a lot of, and actually we should probably talk about that for a little bit, but it's fascinating to me how much interest over a long period of time we actually pay on a purchase of a home. I know banks have to make money. There's nothing wrong with that, but it's crazy if your goal is to pay off your mortgage, that there are some really good plans like you talked about to, shave off time and interest on your home.
Yeah, it is crazy. Like every deal I go through from a compliance standpoint, I have to present an amortization schedule. So you see exactly how each of your payments are being affected to that bottom line or balance. And
Right.
at the beginning of the term, it's about 50-50. If your mortgage payment's $1,000, half of that's going to interest. It's insane. And that balances out. So more of your payment will be going to principal versus interest as you continue on making payments. But that's kind of the beauty of a lump sum payment, is a lump sum payment goes directly to your principal balance, which will kind of give you an accelerator on tipping the scales on that portion going to principal versus interest. So it's a great tool to use to pay off your mortgage faster.
Let's talk briefly about high ratio, people getting interest rates at a better rate, whether it's high ratio, meaning you put down more or less. If someone comes to you or comes to me and says, Ken, I want to buy a house, what's the best interest rate I can get? I'm going to say, go talk to Laura. What are you going to say, or what's your opinion or views on how to get the best rate right now?
So the best rate is not always the best product. I mean, if you're stunted in these prepayment privileges and you can't pay down your mortgage faster, or if you're stuck in the mortgage unless you have a bona fide sale agreement, you're in a tough spot. So rate is not always the most important portion or piece of the puzzle. But regardless, the lowest rates that are available are on high ratio. So that means having less than 20% down. And I do put out mortgage rates and advertise them on the weekly. And clients are always shocked when they said, Laura, you've got, a 2.99% 5-year fixed rate, and you're telling me I'm at 3.14 and I have 35% down. What's the deal with that? How does that work out?
Right.
So, the long and the short of it, I'm trying to think about the easiest way to explain this. CMHC insurance is required legally on any deal that you have less than 20% down. And what that insurance is it's default insurance. So if you don't make your payment and you default on your payment, CMHC kicks in and still makes the payments for you. So although you only have 5% down, you're like a zero risk in the eyes of the lender. So they're happy to give you the best rate.
Right.
Now, on the flip side, with monoline lenders, which I don't know if we'll get to or not, but monoline lenders, meaning one line, one single line of business, and that's mortgages, they're not deposit taking institutions. So they have to raise capital in order to lend it out, which means they need to free up money on their books. And what they'll do is they'll sell off some of their mortgage business in the form of a mortgage-backed security or something like that, and receive another influx to then lend out. If they have an insured book of business that is default proof, no problem getting that off of their books. As soon as they have something that has more than 20% down, that borrower defaults, sorry. So they're going in and they're insuring it still on the back end, and they're paying for that insurance. Sorry, no, they're not paying for that insurance. They're giving you a rate premium so that that offsets their costs and they can still free up cash flow to continue business as usual.
Cool. Okay. So I guess the general question for me would be then, would you, and this is a very general question because everybody's situation is different. Would you recommend someone putting down, let's use a $400,000 purchase as an example, just so that it's easy numbers. So 20% down, $80,000. Would you recommend someone putting down that amount of money in cash and then having that $320,000 mortgage, or would you recommend them putting down, say, 10%, $40,000, and having a bit of a CMHC insurance premium tacked onto their mortgage? And again, I know everybody's situation is different, so very generic question.
If they have the ability to put the 20% down, 10 times out of 10, you're going to put that money down. And the reason being is because the CMHC premium is a percentage based on your down payment, and it goes up to 4%. So if you're putting that minimum 5% down, you're essentially increasing your cost of borrowing by 4%. What would you prefer? A 4% penalty or a what would that be? 0.15% interest rate increase. In the grand scheme of things, you're always going to be ahead by not paying that CMHC premium. Also with CMHC premiums, while you can finance the premium portion of it, so that 4%, taxes on that are due at your lawyers on closing. So it's going to there's a trickle effect and a domino effect. It's not just one and done. It's compounded essentially. So I would always recommend 10 times out of 10 to put that 20% down if you can.
Makes sense. I guess sort of wrap this up. One of the last questions, and I've had this before, clients that are considering buying a new place, but thinking about keeping their existing house as a rental. Talked about monoline mortgages or product. What is your thought, and what have you sort of been seeing with this? Does it make sense to, again, very generic, and there's a lot of different outcomes, but let's use the example, a couple has a townhouse, they're thinking about buying a little bit bigger house, they can swing, a down payment on their new house if they keep their existing house. What are you seeing? What are the issues? What are the risks? Does it make sense to keep that townhouse as an investment cash flow property? Can they get cash flow from it?
Yeah, so a lot of people, what they'll do is they'll refinance, especially when you see kind of the swings in the real estate market, right? And on pre-construction, you close on that house and you've already assumed a lot of equity just based on the time it's taken to completion. So what I've been doing is helping people refinance their current residences, and then when they're buying up, if it's cash flow positive, that's great. Hold on to it. I mean, the last 62 years, statistically speaking, rents have increased. So not a bad position to be as a landlord, being able to increase rents every year, right?
No.
Now, as far as you mentioned monolines, which is great, the way that you show or offset rentals is somewhat different lender to lender. So if you were to walk into your bank, they're going to take the rental income that you have and apply 50% of that. It's called a 50% offset to your ratios and your debt. So typically speaking, in the GTA area, that's not offsetting your property taxes, your maintenance fees, your heat, your insurance, etc. So you're carrying a debt each month. And maybe you are on paper, maybe you're not. Maybe it does offset, but it's not a true capture of what your cash flow is or what risk is involved. Now, certain monoline lenders, so long as there's a couple instances that you need or criteria that you need to meet, the purchase price that you're looking at can't be over $1 million, things like that. You can use a rental off sheet or a rental worksheet offset. So you're plugging in the numbers, it's spitting out a monthly cost based on true values, and you're using that as a liability. So it's increased affordability on the purchase side by just showing a more accurate depiction of what your monthly costs are. The last customers I helped out were able to be approved for $80,000 more with a monoline by using this sort of setup. So definitely worth it. I know not everyone knows First National and MCAP and LendWise and Merrick's and all these different monoline lenders, but that doesn't mean that they're tried, tested, and true. And they can get you sometimes further than what, you know, the TD and Scotia banks and everyone else in the industry are concerned.
Really, really cool. Well, there's a lot of interesting products, interesting solutions out there for people. My last question before we wrap this up, and this has been something that I think has been affecting the market a lot more than what the general public really knows. You know, there's an interesting stat that came out that like close to 50% of people are like $200 away from being insolvent, and which is kind of scary when we think about it. Now, that was a national figure. I think in the GTA we're very leveraged, but I mean, maybe that is applied in the GTA as well. If someone gets into trouble with their finances, are there options, B lenders, are they able to at least go out and potentially get a fix in the process of getting their life turned around, or are they like on the street and it's over kind of thing?
Yeah, so we really only touched and scratched the surface on A lenders, or kind of your standard banks and monoline lenders. There are two other markets out there, being the B space or alternative lenders, and then also a private market as well. And mix are also included kind of in that alternative and private space, mortgage investment corporations. So you can look into those, but they're not always qualifying the borrower or their income. They're looking strictly at property. So they're going to look at it and say, you know what, we know that this is worth this, and they're not getting into the business to, you know, get into a foreclosure situation and sell your home, but that's the way they're kind of viewing you as a borrower. So they'll say, yeah, you know what, it's worth this, it's worth $800,000. You're in a tough spot, no problem. We don't need to see that your income's going to qualify. We'll help you kind of clear some of this debt. They do want an exit strategy. So if there's been a hiccup or something where you've gotten in a tight spot that's not going to last a lifetime, but it was kind of a one-off, they'll work with you on that. So they're kind of a Band-Aid solution, not a long-term solution. Now, having said that, it doesn't come without a big jump in interest rate, and they also charge fees to assist you. So the most expensive way and kind of a lifeline, but there's always an option, it seems.
Right. Okay.
Especially in this market with like GTA houses, right? Property values are being held. If you go down to, I don't know, Port Credit or something like that, where they're not as marketable, you might have a tougher time finding that lifeline.
Right. Awesome. Well, this wraps up our discussion about mortgages. I know we didn't really get into too much, but this kind of highlights what, what's sort of happening in the marketplace right now. And so you do on Mondays, you sort of put out a weekly update. Is that correct?
I do. Hashtag mortgage rate Monday. So I do put an update on where mortgage rates have changed over the last week. And this was the first week where I didn't report a change to any since March 4th. So
wow.
We'll see what happens next week.
Yeah, exactly. So where can people find you? Give us your details.
I am on Facebook and Instagram as well. This is hilarious. We're gonna have to edit this part.
Go ahead.
I don't even know what I just closed I think it's Laura Witt, GTA Mortgage Agent. I don't even know what my Facebook handle is. Is that terrible?
I don't think we're going to even edit that. I think that's like pure raw right there. So you're Laura Witt Mortgages with Instagram. And
there you go.
Let's try and quickly find you on Facebook as a client. Laura Witt. I'm seeing your
Laura Witt Mortgage Agent.
Is that what it is?
Laura Witt Mortgage Agent, but I thought it was at GTA. Anyways, wow.
What I'm going to do, because this is actually really funny and people are going to laugh at this and that's awesome, but it's making human. What we'll do is I'm going to put all the links in the description. So if you're on Facebook or on Instagram or wherever else you're going to see this, Laura's information is going to be there and we're going to find it. The other question I had, and this, I know we're wrapping up here. People have to get pre-qualified before they start looking at houses. Like you have to do that. That's just a given. Is there a difference between, are the pre-qualifying, if someone goes and gets pre-qualified, is that still good enough to make an offer on a property, or do they have to go and get pre-approved? Is there different terminologies in different states? If a buyer is looking at this and going, I'm ready to rock and roll, are they actually ready to rock and roll? What do they have to have?
There is a big difference between pre-qualifying and being pre-approved, especially if I'm helping you out. I pre-approve all clients. I collect all documents up front. I want to make sure that if you're telling me you're earning $100,000 a year, and while that may be true, 30,000 of that is a bonus, or 40,000 of that is your base and you earn a ton of commission, it doesn't always work out to that same amount. So there's a lot of different underwriting that goes on that it's not really clear. So that's my job to kind of decode all that and make sure what you say you earn, you do earn. If you are getting pre-qualified, I actually have a free app where you can go in, you plug in your information, and it spits out a number that you'd be pre-qualified for. Being pre-qualified is just based on the numbers you're inputting, and nothing is being verified. Now, if you're going through and getting a pre-approval, I'm looking at documents. I'm pulling a credit bureau. I'm looking for X, Y, and Z to make sure that if you're putting in an offer, that number you've been given is tried, tested, and true, and it's not just based on hearsay.
Cool.
And I have had clients that I've done a pre-approval for, and they said, well, hold on a second. ABC Bank told me 680,000. Why am I only approved for 600,000 with you? I'm like, I don't know. Did you give them different documents than me? Or nope, everything's the same. And I said, well, thanks for the opportunity for earning a shot at your business, but you got to go with the bank. Calling me up frantically. Oh my gosh, they didn't stress test me. I am only approved for 600,000. What do we do? Well, we've got to get a private deal because you went in firm to supplement that. So work with somebody that knows what they're doing, because you don't want to have to pay the fees and everything else when you've entered into agreement that was a pre-qualify instead of a pre-approval.
And I think that hits on a point of, I always tell my clients that they should talk to a mortgage professional, being yourself, versus just walking into their bank. And for me, the reason is very simple and very clear. Their bank might offer them a special, you know, stick with us and we'll give you a good mortgage kind of thing. But there are so many options out there, and banks are still kind of fighting for your business. I mean, that's how they make some of their money, is through putting mortgages out and getting interest on that. So I would say if you want to talk to your bank, great, but you should definitely talk to Laura and see what your options are. You might get something that's a lot better, and rate isn't everything. You might be able to also get, you know, great terms. You might be able to get like a combination of things that can make the overall package that much better as well. So that being said, it is, let's do this one more time. So we can find you on Instagram at Laura Witt Mortgages, and you can also find you on Facebook. I think it's Laura Witt Mortgage Agent, mortgage something.
Mortgage agent.
Mortgage agent.
It.
There we go. So
and then the tag is, I was right, at GTA Mortgage Agent.
There we go.
I did know that.
You did. You did know that. That is it. That is all. Thank you so much for watching this awesome interview. And we'll probably be back more often. I think it's great to have a conversation with people that are experts in the field. And with Laura specifically, there's a lot of changes that are happening, will happen within the mortgage industry. So if you have any questions, feel free to reach out to her specifically, directly. And if you have any real estate questions, please don't hesitate. You can reach out to me. All the contact information will be below. Thank you so much for watching. Have a great day.
Thanks, Ken.